Determining the trend of the market by daily vertical chart of the market indices like Nifty 50. Section 7M. The most important thing to know about the market is the trend. Since we aim usually to operate in harmony with the trend, a study of our daily trend chart should be the starting point of all our deductions. No one had succeeded in devising a perfect average indices, one which unfailingly represents the action of the market as a whole at all times. In other words, it cannot be said that one average is consistently better than another. Investing and trading is an art rather than science. Hence, we must not undertake to make precise calculations nor expect precision in a general market average. It is important for us to know this, so we will exercise judgment at all times in reading our trend chart. And so we will remember that the deduction we draw from it must frequently be adjusted to confirm what we see in the behavior of wave charts, our group charts, and our individual stock charts. Subject to the above qualification, we will find Nifty 50 index a general satisfactory guide to the trend and position of the market as a whole. We can look for other broad market indices, sectorial indices, and thematic indices too. Regardless of what averages or indices we see, the same line of reasoning as explained herein should be followed in reading the indication given. The charts on screen includes total volume of transaction of all stocks dealt in daily as indicated by the vertical lines rising from the bottom of the sheet. This volume must be considered in conjunction with the study of the price movement. The element of time is represented by the daily additions to the chart from left to right. The closing figure of each day is indicated by a horizontal line across each of this vertical line which represent the range from high to low. The story told by this chart is as follows. We used the period from December 8th to December 17th as our starting point, and without regard to the market history previously recorded, this interval of 9 days marked a sharp acceleration of the previous major decline, culminating in a widening spread of the daily price range and a very marked expansion in the daily volume of trading as the market reached its low point, thus reflecting the panicky selling which takes place under such conditions. The volume on the 8th was around 20 lakh. This increases to 50 lakh on the day of the low point. Tape observers would have noted the fact that a large part of this volume occurred as the market recorded the extreme low and on the rally from the lows. This confirms the fact that the climax of the downward movement has actually been passed and gives us the starting point for our next forecast. We must now assume, in view of the above, that the trend is tentatively upward, but this is subject to confirmation by the appearance of higher support on the next reaction. That is, if on the next downswing, prices should break through the turning point of 135.5 recorded on 17th December. It would be evident that liquidation was not completed and that support which turned the market upward on the 17th has been withdrawn. On the other hand, if it had happened to be the case, the buying support comes in around or at a higher level than 135.5. We may conclude that demand is beginning to overcome supply and that the next logical development for final confirmation of an important reversal will be the market's ability to rise above the top of the last rally, which was around 150 on December 18th. On January 3rd, these averages rise above 152, which gives final confirmation of an upward swing which might develop into a rise of substantial proportion. In taking a position in the market, which of course would be a long position, we have had up to now 3 opportunities. On December 17th, when the market gave indications of having completed a selling climax, and at the same time, as shown by the entry of our vertical chart for that day, was able to rally vigorously on increasing volume. This was the first time it had shown ability to rally aggressively, and the first time increasing volume had been shown on an advance for some time past. On the basis of this tentatively bullish indication, we are justified in establishing long positions if we can get in near enough to lows, so that when we place stop orders on our commitments 2 or 3 points under our purchase price, our stops will be about to 1 to 1.5 or 2 points under the danger level, that is the low of the climax day. 2. Our next buying opportunity is on December 29th, when the market completes 3 days of lower support, but the closing price on each of these days are between 140 and 141, showing that the selling pressure is losing its force. Since the net result of these 3 days pulling and hauling is to leave the averages almost unchanged following a considerable reaction. At the same time, lower volume on the reaction from the December 18th high compared with the volume of the mid-December decline confirms the inference that selling pressure is losing its force, buying power is overcoming it. As it now appears that the market has completed a typical secondary reaction, which has the effect of broadening the zone of support around the 136 to 140 level. To sustain a proportionately more substantial advance than the first recovery, we either buy on this reaction if we missed our first opportunity, or add to our holdings with stops on these positions as before under the danger point, that is the low of December 17th. The average is now on the springboard. Third point, on January 3rd, the average goes into new high ground, overcoming the previous tops of December 18th, 19th, 20th, and January 2nd volume. Tends to increase on the rally days, December 30th to January 3rd, an indication that is characteristics of a bull trend. However, this is the least favorable of our 3 buying opportunities so far, since we would now be purchasing on an upwave, thereby materially increasing our risk, whereas previous commitments were established on downwaves close to the danger point. Remember that we are now studying the average or composite price of 50 stocks, which is our chief guide as to the direction of the trend. It is impractical for us to operate in all of these 50 stocks at the same time. Therefore, we must select when we wish to trade or invest the individual issues which are showing the greatest technical strength at that time. For this reason, we must turn to our group averages or our position sheet, which enables us to select the best out of our list of individual stocks. In order to find 1, 5, 10 or more stocks which promise to yield the largest profit in the shortest time. Having decided that the trend of the market is upward, we must thereafter continue to trade on the long side until there are indications of a change in trend, or until the trend is in doubt. We must always be on our guard against such changes, and when the market is in doubt, we must take a neutral position, that is, be out of the market. For the next several days until January 9th, the market makes further progress on the bull side, recording 156.5 on that day. But observe that the closing figured on the 6th, 7th, 8th, 9th and 10th are all within a range of about 1 point. That means the market made no upward progress as a net result of 4 days activity following the 6th. The daily volume shows a tendency to taper off, which may mean a lessening of demand at the top of the swing to January 8th. This conclusion is partly confirmed by the shortening of the upward thrust from the 3rd to 7th, indicating that it was hard work advancing the market from 150 to 155. Buyers now seem reluctant to follow price upward. On the day when the high of 156.5 is recorded, the volume increases abruptly compared with the volume of the preceding sessions at the same time that the price runs up to a new high only to close near the day's low and actually below that of the previous session. All of the foregoing is evidence of the approach of a corrective reaction, but we still hold our long position because as yet we have had no indication of important distribution. Such a reaction begins on the 12th and the low point of it offers on the 16th. Volume on the reaction diminishes appreciably compared with volume on the rise from the December 29th low. A bullish indication showing that the selling pressure is light on the 16th. The closing is nearly at the high point of the day, a bullish indication which is the reverse of the bearish indication on the 9th. This is our first sign that the reaction is nearly over. So here we have a buying opportunity in expectation that the advance will be resumed. Further confirmation of this comes in higher support on the 17th and in an almost complete drying up in volume on a dip to the same low level on the 19th. The closing price on the 15th, 16th, 17th and 19th show support within a narrow zone, mostly around 147 to 8. We must therefore look for the advancing tendency to be resumed. Then follow 4 days in each of which we see higher tops, higher bottoms and higher closing levels, accompanied by gradually increasing volumes, bullish behavior. This brings the market up within a fraction of the high figure of January 9th, where on the 23rd a volume surge after 4 days almost perpendicular advance warns us of a buying climax. But here in any case we may expect hesitation or reaction due to the influence of the previous top, that is January 9th. Now observe that for the next 13th session following the 23rd, the market fluctuates within the range of 156 to 151, a very narrow range for the average. This is because it is called upon to observe offerings representing stock purchased by over anxious bull who got hooked around the high level of January 19th and perhaps other quantities bought on the way down in 1930 during the period not shown on this chart, purchases made by people who are now eager to get out even. Such absorption is evidently completed by February 9th when after closing almost at the top on the previous Saturday an advance into new high ground 165 by 8 is recorded. Note how the speed of the advance tends to increase, the average gaining 9 points in 2 sessions, 9th and 10th. See also how the volume increases to 40 lakh shares and over on these 2 days compared with the previous volume of 10 lakh or 20 lakh a day for 13 days past. The exceptionally large volumes of the 10th and 11th plus the failure to record any material further gains on the high volume of the 11th as usual is an indication of some distribution and a setback. On the 11th, the average makes a high of only 1 point above that of the 10th and closes at only a small fraction gain. Large volume, a large supply overcoming demand. Now, as we watch the supporting point for the next 5 sessions, 13th to 19th, we find that they are all around 160 to 162 mark. Meanwhile, volume decreases promptly on the dip to 160. This says there is another advance coming. The market is not ready to turn downward yet. On the 17th, there is an attempt to run the average up to a new high, which fails. The closing is almost on the bottom and the volume increases noticeably over that of the three previous sessions. It looks at first as if this might be a buying climax preceding the end of the rise, so we bring the stops on our long trades up within 1 point of the February 14th low as a precautionary measure. We have now had a substantial advance followed by 6 days lack of progress and comparatively high volume, which means the market has reached a critical position. But the average is immediately supported the next day, and on the 19th, the closing is nearly at the top. It thus shows ability to rally away from a possible danger zone and willingness to try to negotiate the resistance around the tops of the range at 166. The lower volume under these conditions may mean that the supply of stock has become scarce, so we sit tight. Next day, the 20th, the average advances again into new high ground, observing the overhanging offerings of a volume increasing from around 25 lakh to 40 lakh. Shares on the 21st to a new high and a higher closing, with the volume up to 50 lakh shares, thus for making progress in proportion with the expansion of volume. On the 24th, holidays intervening, it registers a further gain of 27 by 8 points in price, a little over a point and a half in the closing figure on a volume of 53 lakh shares. We now become very suspicious of this advance on such large volume, and particularly the failure apparently on the next day to hold a quick upthrust to a new high on such a high turnover, which is characteristic of distribution, suspecting that this volume surge may be climatic. Accordingly, we move our stop orders up within a point or two of the lows of the 24th. Next day, February 25th, we observe a lower top and the bottom and a lower closing, as well as a loss of the two previous days gain. Indicates that supply is overcoming demand and confirms the previous indication of a probable reaction. If our stops have not been caught, we now promptly close out all our long position and select from our list of individual issues the best 5 or 10 that are in the weakest technical position and sell them short with the stops of 1 to 3 point above the danger level, that is the high point of the advance. After such a prolonged rise, we may expect a more substantial reaction than any we have had since the December-February bull move started, and perhaps an important decline because there have been evidence of distribution extending as far back as February 10th. On the 26th, the high, low and closing are almost identical with those of the previous day. The market therefore is making no further progress upside on heavy volume, but the demand is still enough to hold it within the previous range 168 to 173. On the 27th, however, we note a clearly lower top, bottom and closing and some, but not a very large shrinkage in volume to about 37 lakh shares. The significant feature of this day's action is that it marks a pronounced change in the market's behavior. It is the first time since early December that volume has remained so high on a reaction. Theretofore, volume has been shrinking promptly on setbacks. The fact that prices cannot continue to advance into new high grounds combined with the comparatively high volume leads us to conclude that the big fellows are unloading, and the relatively large volume on the reaction of the 27th indicate that they are filling up all the buyers on the way down from the highs with what they were unable to sell in the range between 168 to 173. We must bear in mind that prices have now advanced from 135 and half to 173, 37.5 points. That is a big rise in the averages, because such a rise indicates that many individual stocks used in marking up the averages have advanced nearly double that amount. Also, the angle of the advance as shown by placing a ruler along the lines of bottom from February 5th to 18th is such that it is unlikely that this pace of acceleration of rise can be maintained. This is emphasized by an even sharper angle from the 18th to 24th, when the supporting points were raised considerably away from the previous established diagonal support line. This sudden whooping up of prices after such an advance suggests the application of hypodermics, which combined with a high and expanding volume increases the market's vulnerability to heavy realizing sales and likewise increase the danger of a general withdrawal of experienced operators who refuse to continue to buy at those levels. It is such conditions as this, created as they are by large interests who are managing the markets, are detected by floor traders and large outside professional and recognized as indication of a turning point. The latter now add to the supply by getting out of their long stocks and taking short positions, thereby not only helping to assure a turning point but also placing themselves in a position to profit by the downward swing. We must act in harmony with these word operators and put out more shots, with stop orders placed as before above the February 24th resistance point, as the action of 27th gives us a new selling point. On March 2nd, after a little rally, the average declined 6 points from the high of the day and closes near at the bottom. If we have ignored all the previous warning of a gradual weakening of a technical position, we cannot ignore this decisive breaking of the very backbone of the advance. This day's behavior shows definitely the heavy withdrawal of bids underneath the market, and the volume 33 lakh remains high, very high, in comparison with the volume on all previous reaction since December 8, indicating that very substantial lines of stocks are still being pressed for sale by large interest, having accepted some or all of the bearish indication of the foregoing 6 sessions. We conclude that the upward trend has terminated, at least for the time being. After running the greater part of December, January and February, and that a change to a downward has begun, this is to say we are entering a substantial intermediate reaction which may develop into a decline of major proportion. It looks as if we were correct in our assumption that some distribution was accomplished as early as February 10th, but the main move upward was continued in order to facilitate unloading of stocks which had not topped out at that time. So far we saw the rise of this index. So let's close this part, and in the next part let's see how the fall is.